Welcome back to our Payments Industry Masterclass. In this lecture, we're going to talk about something that every merchant, payment processor, and issuing bank deals with, but very few truly understand: chargebacks and disputes. This topic is crucial, not just for protecting revenue, but also for building long-term trust in the payment ecosystem. Let's dive in. What is a chargeback? A chargeback is a process where a cardholder disputes a transaction and requests their money back from the issuing bank. It's essentially a reversal of funds, initiated not by the merchant but by the consumer, often due to fraud, dissatisfaction, or error. Think of it as a safety net for consumers, allowing them to recover funds in case something goes wrong with a purchase. But for businesses, chargebacks can be costly, both in terms of lost revenue and reputation. Difference between a refund and a chargeback: a refund is initiated voluntarily by the merchant, maybe because a customer returned a product or cancelled a service. A chargeback, on the other hand, is involuntary. It's forced by the issuing bank after the customer files a dispute. The merchant often doesn't get a chance to negotiate beforehand. Reasons for chargebacks: there are three broad categories of chargebacks. Fraudulent transactions. The cardholder claims they didn't authorize the transaction. This could be due to stolen card info, phishing, or identity theft. These are also called unauthorized or no cardholder authorization disputes. Merchant error. Duplicate billing. Wrong amount charged. Goods not delivered or services not rendered. Incorrect product shipped. Cancelled subscription but still billed. Friendly fraud. The customer receives the product service but still files a chargeback. This might be due to buyer's remorse or intentional abuse of the system. Lifecycle of a chargeback. Let's break down how a chargeback flows through the payment ecosystem. The cardholder contacts their bank and disputes a transaction. The issuing bank provides temporary credit to the cardholder and forwards the dispute to the card network. The card network, Visa, Mastercard, etc., forwards it to the acquiring bank. The acquiring bank notifies the merchant and asks for supporting evidence: invoices, shipping proof, communication records. The merchant has a limited time, often 14 days, to respond with Representment. Based on the evidence, the issuing bank makes a decision. If the merchant wins, the funds are returned. If the customer wins, the chargeback stands and the merchant loses the sale plus a chargeback fee. Common chargeback reason codes. Each card network has a list of reason codes to classify chargebacks. Some examples: Visa 10.4 fraud card absent environment. Mastercard 4853, cardholder disputes quality. Amex F24, no cardholder authorization. RuPay 72, goods services not delivered. These codes help all parties understand the nature of the dispute and what evidence is needed. Financial impact of chargebacks. Merchants not only lose the transaction value, but may also pay chargeback fees, typically Rs200, Rs1, 000 per case. Operational costs, manual investigation, documentation. Increased MDR, higher risk leads to higher fees. Risk of blacklisting. Too many chargebacks can lead to account termination or being placed on a monitoring program, like Visa's Chargeback Monitoring Program or Match List. Hello, and welcome to the very first chapter of our journey into the payments industry. Let me ask you something. When was the last time you paid for something? Maybe it was your morning coffee, an online subscription, or even groceries. Whatever it was, you used a payment system. But have you ever stopped to think about what happens behind the scenes when you pay for something? Today, we're going to answer a simple but essential question: what is a payment system? By the end of this session, you'll have a clear understanding of how these systems work, why they're vital to our daily lives, and how they've evolved over time. Let's begin with a definition. A payment system is a network of processes, rules, and technologies that enable the transfer of money between parties. It's what allows you, the buyer, to pay for goods or services and ensures that the seller gets the right amount of money. Whether you're swiping a card, transferring funds through a banking app, or handing over cash, a payment system is at work behind the scenes. But let's not stop there. A payment system is much more than just a mechanism for moving money. It's a carefully orchestrated process designed to ensure that payments are fast, secure, and error-free. It provides the foundation for modern commerce, enabling businesses to thrive and consumers to transact with ease. The three core components of a payment system. Every payment system, no matter how advanced or simple, relies on three fundamental components. The payer, this is the person or entity initiating the payment. In most cases, that's you, the customer. The payee, this is the person or entity receiving the payment, like the cafe where you just bought a latte or the online retailer where you ordered a new gadget. The intermediary, this is the entity that facilitates the transaction, such as a bank, a card network, or a payment processor. Now let's see these components in action with an example. Imagine you're buying a cup of coffee. You tap your card or phone on the cafe's payment terminal. In just a few seconds, the cafe receives confirmation that the payment has been approved. But what happens behind the scenes during those few seconds? First, your payment details are sent to the payment processor, which checks with your bank to see if you have enough funds. If everything checks out, your bank sends an approval message back to the cafe's bank and the money is transferred. All of this happens so quickly that you don't even notice it. This process, known as payment processing, is the beating heart of any payment system. It ensures that money flows smoothly and securely from payer to payee. A brief history of payment systems. Now that we know what a payment system is, let's take a step back in time and look at how these systems have evolved. The earliest form of payment wasn't money at all, it was barter. People exchanged goods and services directly. For example, a farmer might trade wheat for a fisherman's catch. But barter had its limitations. It wasn't always easy to find someone who had what you needed and wanted what you had. To solve this problem, early civilizations began using commodity money. Items like shells, salt, and metals that had intrinsic value. Eventually, these were replaced by coins made of precious metals like gold and silver. Coins were durable, portable, and universally accepted, making them a significant advancement in payment systems. Next came paper money, which was first introduced in China around the 7th century. Unlike coins, paper money was lightweight and easy to carry. But it also required trust. People had to believe that a piece of paper was worth the value it represented. Fast forward to the 20th century, and we see the rise of checks and credit cards. Checks allowed people to make payments without carrying large amounts of cash, while credit cards introduced the concept of borrowing money for purchases. Today, we're living in the age of digital payments. From online banking to mobile wallets like Apple Pay and Google Pay, technology has revolutionized how we pay for goods and services. Digital payments are faster, more convenient, and often more secure than traditional methods. Acceptable chargeback ratios. Card networks typically expect merchants to maintain chargeback ratios below 1% of total transactions or 100 chargebacks per month. Exceeding these limits can trigger penalties or even termination of merchant accounts. Preventing chargebacks. Here's how merchants and PSPs can minimize chargebacks. Clear billing descriptors. Ensure the name on the card statement matches your brand. Transparent policies. Clearly communicate return, refund, and delivery terms. Customer service. Offer fast, friendly support to resolve issues before disputes escalate. Fraud detection tools. AVS address verification. CVV checks, velocity checks, device fingerprinting, 3D secure authentication, delivery proof, always use trackable shipping and collect delivery confirmation. Subscription reminders, notify users before auto-renewals to reduce surprise charges. How fintechs handle chargebacks. Modern payment processors and gateways offer built-in tools to reduce disputes. Dispute management dashboards, auto-response to low-risk claims. AI-powered fraud detection, bin-level monitoring, real-time notifications to merchants. They also help automate documentation gathering, like invoices, chat transcripts, and shipping logs, to make representment easier. Role of the card network. Card networks act as arbiters in the chargeback process. If the issuing and acquiring banks disagree, the card network performs arbitration for a fee and makes the final decision. In many cases, the process ends at the pre-arbitration stage where one party backs down after reviewing the evidence. New trends in chargebacks. Digital goods and subscriptions. These see higher dispute rates due to intangible delivery. Real-time dispute APIs. Visa and Mastercard are rolling out APIs that allow merchants to respond instantly to disputes before they turn into full chargebacks. Machine learning. Predictive analytics can help identify transactions likely to be disputed, allowing preemptive action. First-party fraud management. More tools are emerging to detect and counter friendly fraud. Chargeback alerts versus chargebacks. Some services offer chargeback alerts, early warnings that a chargeback is coming. Merchants can use this window to issue a refund or resolve the issue before it escalates. Examples include Verifi, Visa and Ethoca, Mastercard. These help reduce chargeback ratios and protect merchant reputation. In our next and final chapter of this module, we'll look at fraud detection, how the payments industry is fighting back against bad actors and protecting both merchants and consumers. Until then, stay secure and stay sharp.